Hey, this is Sean, the founder of Airworthy Capital. I wanted to do a video interviewing our partners, Radiant Storage. We've done some self-storage deals with them already, and this video is really going to encompass the whole idea of self-storage from top to bottom. And it's really geared towards someone who has never invested or been involved with this asset class before. So we're going to talk everything about to how they acquire units, things like how does maintenance work, how do we get out bad tenants, and everything in between. But first, I wanted to introduce myself. I'm Sean. My background is in aviation. I flew active duty in the Air Force. And then after getting out of the Air Force and finishing my MBA, I really started my career in real estate. So I started acquiring residential properties and then quickly moved on to commercial, doing apartment complex deals in Texas. Since then, I've had other successful businesses in fintech, uh, aviation, electronics, real estate. I'm also an active angel investor helping start up other businesses. And my partner is Jesse Hunting. He is someone I've known since undergrad at Penn State. And he's super sharp. He's done a really high volume of real estate transactions with his previous jobs. You can see he managed almost $1 billion loan portfolio. And he's really taken his knowledge in real estate and he's using that to help people that are, not in a great economic condition in Philadelphia to kind of help foster some affordable housing and give people a chance at economic mobility. So his strong suits really lie in the due diligence and looking at deals and the operations part of that. So we make a great team with Jesse kind of looking over deals and myself helping source the deals and move everything else along with the deal flow. So with that being said, I'd like to interview Pal and Juan from Radiant Storage. These are our partners that we've done other self-storage deals with, and we plan on doing more in the future. So we'll start off with Pal. Pal, tell us a little bit about yourself, how you got into real estate, and why you keep doing it.
Yeah, absolutely. Appreciate that, Sean. And my name is Palchi. I live in Los Angeles. Kind of grew up as a California kid, although I spent 5 years in the Midwest. Started investing in real estate. My first deals were back in 2012, but my very first house that I bought was in 2015, and it was kind of an eye-opening experience for me to buy something that was out of state, outside of where I lived, and I bought it in Kansas City. About a year later, when I started buying multifamily properties, and then was heavily involved in multifamily. Really, the reasons why was just for scale. Doing small property was just feel like I couldn't scale, and then so started getting into multifamily. And let's see, I would say that Juan and I were partners in a bunch of different properties in multifamily, and then we transition to self-storage really around the time of COVID, but we can get into that. But I mean, when we're talking about for the whys for me, like why did I get into this? Really, it's all about freedom for me. It's the idea that, hey, you know what? I don't like it just being controlled with my time. I like to have my time being able to do what I want to do. And so I have a young family now, a son is only a little more than a year and a half. He's about a year and a half right now. And I just want to spend a lot of time with my family. I want to see him grow up. I want to have him. I just want to be around him as much as possible. And I really just enjoy the freedom of the idea of that. Hey, if I can have this financial freedom and be able to do what it is that I want, I can live wherever I want. That I can do the activities that I want. That I can spend the time that I want. Watch him grow up and spend time with my other family and friends, and just have that freedom. So that's the reason for me.
Thank you for sharing, Pal. Juan, over to you. Same questions. How did you get involved in real estate? Tell us a little bit about yourself and what is your why for doing this?
Great, great. Thank you, Sean. This is Juan. I'm currently in Dallas, Texas. If we go back, I was, I was basically grew up in Argentina, South America, and then in a high school year, I went to the United States, and then soon after, graduating from high school, I joined the U.S. Army, and then from there, I went to peacekeeping mission to Kosovo, served my years, and then I got discharged from there. And soon after that, I started a clothing business, and then thank God, it was very successful. And something changed on my life when I had my daughter, basically. So once I had my daughter, I start looking the life a little bit differently, and it's very similar to Powell in that sense because I wanted to have more freedom, and not being threatened in time and space and things like that. And then I was looking for what kind of vehicle that I can choose for my life going forward, and that happens to be real estate. So since then, I think Powell actually covered a lot of them. I jumped in and then I focused on real estate holdings and then partner with Powell, bunch of multifamily going forward after that, and then now we are in self storage. And then I think in the further slide we're gonna show what we did in self storage.
Thanks for sharing that. And I wanted to share with everyone else. All three of us met down in Galveston almost about a year ago now. I've been trying to get into self-storage for years now, and was introduced to this team and met in person. Some things that really impressed me is how they leverage different people's expertise on the team, because it's not just Juan and Powell managing these facilities and with Radiant. There's other members of the general partnership which bring different aspects of what they know into it. And yeah, I just wanted to share that. So you've obviously sold me, we've all worked together, and I think we work together pretty well. So you've had success doing multifamily. What brought you into self-storage? And especially now, I mean, we're going into recession. Isn't this a bad idea to be getting involved in new asset segments and taking out loans when interest rates are going up? Like, why self-storage?
Sure, sure. And I can get into that, and I think our slides will get into that here, Sean. And so, what one thing I do want to say is that I appreciate you talking about our collaborative approach to other deals that we do, because that's something that Juan and I have really focused on. So when Juan and I have kind of come up through the multifamily world, there was a lot of experience and a lot of things that we wanted to get maybe from some of the main sponsors that we were working with, that we just didn't get a lot of the exposure that we wanted, right? And we didn't learn as much as we'd wanted. So and it's kind of varies from different properties that we were on. But when we decided, hey, when we're the main sponsors of these properties, we want to make sure that we have a culture that invites people, is very collaborative, and takes advantage of other people who have a lot more talent or skills or experience in certain fields that we don't have, and we can make the property run better that way. And so that's something that we have always thought from the very beginning, that's how we're going to do it. We're going to actually, when we are the main sponsors of a deal, we're going to do it like this, and that way people gain more experience themselves. We try to offer as much transparency as possible, and that's just for who we are as far as like in our philosophy as a management team. And so when I get into why don't I go ahead and get into the slides? Is that okay, Sean?
Yeah, absolutely. I appreciate you sharing that. That's one of the things that immediately put me at ease. I've been in commercial real estate, multifamily for a decade, and there's not always the best transparency. And I did have the feeling before, there's maybe one person or two people running this, and they're not really taking input from the team. This feels to me like much more of a collaborative approach, and I think it lends to its success that way, because you're really leveraging everyone else who has different talents, and it is like a learning journey for all of this. So I really appreciate the transparency and the honesty, and that's why I immediately had a lot of trust in both of you.
Yeah, appreciate that. Thank you. Excellent. So let's go ahead and get into the slides here. And so let's talk a little bit about the benefits of self-storage. All right. So, just as self-storage statistics wise, right? Everybody, I would assume at this point, what self-storage is. It's pretty popular, but some people don't know how popular it is. Basically, we're talking, you see some stats here, is a $39 billion industry, 1.7 billion net rentable square feet. These are all big numbers, right? And sometimes they don't mean a lot. But when you take all the McDonald's, all the Starbucks, all the Dunkin' Donuts, all the Pizza Huts, all the Wendy's, all of them, and you put them together, there's somewhere around that 50,000 mark, right? But there are more self-storage facilities than there are all of those combined. That's kind of like a sort of mind-blowing for people to think there's more self-storage facilities than there are of just McDonald's. I mean, I see McDonald's everywhere. And you add all these other or Starbucks. I mean, Starbucks are everywhere. So But if you add them all together, there's more self-storage facilities than there are of these big, well-known brands. And so it is out there a lot more than probably in the general public would think. Right? Now, one thing you asked about was during the Great Recession, right? Well, or just recessions in general. What is self-storage? Like how does self-storage perform? And self-storage is one of the newest real estate asset classes, right? It's a fairly new asset class. It's probably the oldest it's been is probably say 1970. So those are the very, very, very first ones. But 1980, some were built, 1990, and then more recently that a lot of them have been built. And so let's talk about what self-storage did during some of these recessions. All right, so let's talk about like 2008, 2009. Most people can remember 2009 being the Great Recession. Right now, if you look at the what we call the REITs, the self-storage REITs, real estate investment trust. These are publicly traded companies. They're generally seen as the bigger, basically the big boys in the industry, right? This is the ones that you may have heard of: Public Storage, Extra Space, CubeSmart, Life Storage, right? These are big names. They're sort of the spearhead of the asset class. These are what just the names that are out there that most people recognize. Okay, and being publicly traded companies, they have to do all the reporting for publicly traded. You can buy these stocks in these REITs. Now we look at how self-storage REITs did during this time. Okay, you can see that during 2007, 8, 9, 10, when things were going bad during this recession, how did this REITs perform against the other REITs, the other real estate investment trusts in other asset classes, right? So you see it far outperformed them in all these other asset classes. And then if you look at specifically how did the S&P do during this time, you see that the S&P 500 during this time, it was significantly lower than what the self-storage REITs did during this time. All right, it's just kind of like, and that's what lent it to the first. It's got a reputation during this point in time of being a recession-resistant asset class, right? Now let's talk about a little what happened more recently, right? Let's talk about during COVID, because people want to know what happened during this COVID time. So COVID, it's classified as a essential business, right? So it could operate during this time. During this time, rent growth, the national rent growth actually grew during this time. So you can see that it went up 12.7%. You can look in these different metros that the rent growth during this time, year over year change, July 2021 versus the year before, it's significantly higher in almost not all of them, but in a lot of these places. Now, the reason why, as you can think about, is that what happened is that when the U.S., I'll just talk about the U.S., when the United States shut down, what happened? Everybody started to move home and stay home, and everybody had to do work from home. Well, all of a sudden, these big desks and dressers and couches that were occupying different rooms and lamps and stuff, they needed to be moved out because people needed space, because other family members were moving home, kids were there all the time, so you can't have all these, they need to run around the house a lot. So everybody moved that stuff into storage, right? And so storage just became a place to put stuff. So at this point, that's why it grew, right? And with more and more businesses going more to like a hybrid model of, you could stay at home sometimes, or you can still stay at home, and a lot of other businesses, we don't project, like, all the projections for this is like, this is probably here to stay, right? It's kind of fast forwarded a lot of what they'd seen or projected in the future years. So the rent growth that happened during COVID time was another, I guess, feather in the cap for self-storage to say that this is, again, an asset that is resistant to recessions here. So another kind of feather in the cap. You can never say anything is recession proof, right? So because you don't know what the recession kind of holds at that time. But in the last two recessions, self-storage did extremely well. Now, in terms of just like, hey, what are the other things about self-storage? You know, I understand that I can move my stuff and I can and I have to pay rent while there. Well, there's alternative revenue streams inside of self-storage, right? There's things like tenant insurance. So tenant insurance is something that we make mandatory, and it's one of these things that half of the industry has it, half the industry doesn't have it. But in general, if you can tenant insurance, you require your tenants to pay insurance on their on their unit. It's a monthly charge. It's usually somewhere around $10, can be $10 to $15. And us as the owners, we actually receive a commission of that, right? So we receive a portion of that as far as a commission to having that there from the insurance company. So that's a revenue stream for us, and it also protects the tenants, right? And there's other things. So if there's merchandise sales, there's excess land for expansion, storage auctions. Well, we can get into how storage auctions work, but cell phone towers, truck rentals, notary services, PO boxes. There's many different ways that you can achieve different revenue streams through self-storage. Now, we don't do all of these. I'll tell you that Radiant Storage, we don't do all these because of our strategy, but they are all available, throughout the industry. One thing that I wanted to go over just really quickly with different asset classes, like I mentioned that Juan and I came from a multifamily background. Well, there are certain things that have advantages, right? Advantages of self-storage and advantages of multifamily. You can take a look at the list here. This is not, like a studied list. This is really from my perspective and Juan's perspective when we compared what we're doing in multifamily to what we're doing in self-storage. So,
hey, Pal, quick question. I know you talked about, why self-storage did well in the recession. Me, myself, my background was multifamily, but also a lot of single family. And the things that were my biggest woes as a landlord doing single family were evictions. And then I can only adjust rates or rents every year. So how does self-storage react with that? And how do you think, is this going to be a value add with inflation? Are we able to react more quickly?
Yeah, absolutely. So those are definitely different keys in terms of the asset classes and how they operate, right? So let's talk first about non-paying tenants, right? So this is the situation you get into with multifamily, single family of tenants that stop paying, especially during a recession. You're a little nervous that, hey, they lose their job, are they going to pay? What's going to happen? And then what's the process, right? So in residential, you go through an eviction law, right? They're all evictions. You have to go through an eviction. Now, evictions are laws that are meant to protect both the tenants and the owners. And but it's really, hey, we just don't want to be able to just throw people out on the street for no good reason, right? And those laws are, that some states are more friendly to the tenants, some states are more friendly to the owners. There's a lot of mixture, and there's a lot of debate on kind of things going on right now, whether living in somewhere is a right, or is it, something that's earned. Okay, now self-storage is different. Self-storage is not classified. It's not under the jurisdiction of eviction laws. It's under the jurisdiction of lien laws, and lien laws are really about people's stuff, right? And if you think about it, lien laws or lien laws in general are more favorable to the owners, right? And when you think about, okay, a lien law, do I as a person have the right to take my stuff, like I'm going to take my desk and couch and I'm going to put it on somebody else's property, and they don't have the right to remove it or get it off their property or charge me for it? I don't think anybody really in the United States feels at this point that you can do that you have the right to just take your stuff and put it on somebody else's property, and they can't do anything with it, right? So storage, this is what the laws that we operate on. In storage, when somebody doesn't pay, I'll try to go over this quickly as far as like a difference between, say, residential and say self-storage. In residential, somebody doesn't pay, probably by the 5th day, they're late. Okay, so now they have maybe a late fee on there. Day 15, you send them a notice to quit or pay. Day 30, you're basically telling them, okay, we're going to start an eviction. It's going to go through. another 30 days at least. And then, so you're up to 60 days. And I'm talking about some of the faster states, 60 days. And then you can basically go ahead and move forward with the eviction. Right? It takes maybe a week or two after that. And with that week or two, you may have to, if the people do not leave, you may have to get a sheriff or a constable, right? And that incurs another cost of probably about $600. And you probably have a bunch of stuff, you need to move that stuff out. So you need to maybe, if they leave that stuff, you have to have a moving company. You can't just go get it and throw it in the garbage. You have to have a moving company take it and actually secure it, and then they can pick it up later. And that's like another $600. So that's almost $1,200. And not including 2.5 months of back rent, plus late fees, plus what condition did they leave your property in? Is it likely that they left it in pristine condition? Unlikely, right? It's more likely that they, it's wear and tear plus extra damage. You're probably at the very minimum, you got to paint the property or paint the interior, and you got to clean the property, right? So that's another, say, $700, $800 minimum, $800 minimum, plus the 2 months rent, plus late fees, plus potential sheriff and moving companies, right? And then you got to turn it all, and if nothing else needs to be fixed, you obviously see that can go into thousands of dollars pretty quickly if you need to replace anything large, right? Well, that's what you do in an eviction, one residential. Let's take what you do in self-storage. Self-storage, somebody stops paying, all right? On day 5, they're late. And day 6, what happens is our team goes out to the property and we put another lock on the storage door, right? So now it's our lock on there. And we shut off their gate code. So now on day 6, they can no longer enter the facility unless they call in or update their account and pay there and get their account basically in good standing. And if they actually do hop the fence or somewhere, able to get in, well, they have another lock on the door, like, right, a very secure lock that you can't just break. You have to take a grinder to it. So they have basically no access to their stuff, right? And then what happens is they don't pay. Okay, again, it goes through about another 30 days, and then after another 30 days, it goes through an auction process. You go through an auction process. So you'd say you take, again, 60 days auction process. The unit goes to auction. It sells at auction. Now, say it sells at auction for $200. Well, and say we're owed $150. Where for back rent, it's $150 plus any late fees or admin fees or maintenance fees. Anything that we are paid back first. So we as the owners, we are paid back first. Anything that is left over is basically kept in an account that the old tenant can claim. So if we're owed $150 of the $200, then we'll get $150 back right away. $50 will go into an account that they can retrieve at that time. So we get made whole first. They don't. They don't get. As a landlord, a residential, you just don't have that same option. You can't lock a person out at after 5 days, and then are you going to actually collect any money? That's that. Very, very unusual. And for us, when the turn costs, right? When you're talking about turning the actual unit, I mentioned that you at the minimum you have to paint or clean the unit at the minimum, and maybe takes a week or two before all that's done, and then you can start renting the unit. Well, for us, we just have our maintenance guy go out there. If there's anything in there, they just throw it in the garbage and haul it off, or nothing's in there, they just sweep it out, make sure it's all clean, put a new lock in there, shut the door, and it's ready to be rented, right? And they just update it in our software, and it's ready to be rented. So those are some of the things I would say that are the differences between the how we're treated, with non-paying tenants. Does that answer your question there, Sean? Sorry, it was kind of a long-winded answer.
No, I appreciate it. And then are you able to, so when I'm renting someone a house, my lease is usually 12 months. What does that look like for self-storage?
Yeah, exactly. So self-storage, they're all month to month, right? So all of these leases are month to month. So you would think that sometimes, wow, so that means your tenants can move out after like a month. Yes, they can. Or they can move out after 3 months. Yes, they can. All right. But what that does is that gives us the flexibility of changing rents, changing rates. And so rates can go up or down right, during this time. And a lot of times that means if rents are going up, we can increase them faster. And if rents need to go down, well, we can bring them down a little bit as we need to lease up more units. What that also does, though, is you think about like, well, a person can go in there and just rent for a month and then leave. True, they can, but as if you just moved a bunch of cabinets and couches and old TVs and stuff like that into a storage unit, probably took you at least half a day, maybe all day, and it's not something that you really want to do again. So this is the mindset of most people. So you just think about the mindset. Most people that we have been in there for over a year. You look at all of our facilities, they've been in there for over a year, and you just are not inclined. There's not enough pain for, say, $100 a month, or maybe it's $75 a month. I don't know, 150. It depends on what size. There's not enough pain involved to say, oh, I really want to ruin my Saturday to go move my stuff to somewhere else. And so people just keep it there, right? They just know, okay, it's there. I don't want to throw it away. I have some sentimental value for these lamps and these dressers because that's what I used in college. Well, they're still there, and they're going to stay there until there's enough pain involved. And that pain, truthfully, doesn't happen usually within the first year. And on one of our just a quick story, one of our facilities, we took it over. It was built in like 1986. So I went through the rent roll one time when we were buying the property, just to look at like, what's the oldest tenant that we've had there? And the oldest tenants were there from 1986. And so we bought this property in 2021. So there's people that have had stuff in their facilities, in the facilities. And I think there's about 10 people that had stuff in there since 1986. So it's like a long time. You have anything to add there, Juan?
Oh yes, as an average, when we take over our self storage, as an average, you'll see about 3 years. I mean, some people leave earlier, some people leave like 10 years later or whatever. But as an average, overall, it's about 3 years.
Yep, awesome.
That's incredible. Thanks for that explanation. That really makes me, feel a lot better during these rising inflation times. We're able to adjust, up or down fairly quickly, and that's a huge value add over single family and multifamily.
Mm-hmm. Absolutely. So let's see. Why don't just talk about Radiant Storage in general? Like, what is our philosophy and our background, right? So Juan and I started Radiant Storage and bought our first property in 2021. So you can see we established in 2021, buying our first property. So why we did this was during COVID. Okay, so when COVID hit, we were still going full bore multifamily, and that's what we thought we were going to be doing that for decades. Well, when COVID hit, we decided, hey, we're going to take a pause on buying multifamily. There's just too much uncertainty around what's going on. There's eviction moratoriums. The lending is all over the place. We don't know what's going to happen. So let's not buy anything for 6 months. Okay, no multifamily for 6 months. So what should we do during this time? Well, we're not going to just look at a bunch of deals and underwrite them and not buy them. So we thought, let's look at a different asset class. This is where we came with Radiant Storage. So let's say, well, what asset class do we like? So let's check out storage first, and then if we don't like it, hey, we'll just kind of toss it out the window as we don't like it. If we do like it, hey, let's actually pursue it. So we dove in, did a lot of studying, did a lot of research, education, talking with a lot of people, and then the more and more that we got into it, the more and more we thought, hey, this is something that we should move forward with. Let's actually go ahead and buy a property. But let's buy a small one, because all of our network knows us as multifamily people, and we don't want to tell them all of a sudden, hey, COVID's here and we're changing, and then they're going to be like, why are you guys doing this? Let's just buy a small one. Let's do it with a small group, and then let's find out if this works. And if it does work, then we'll open it up to the rest of our network. If it doesn't work, then hey, we just, it's a lesson learned, and it's a small deal. We don't have to, won't incur that much pain. Okay, so that's what happened, and we bought our very first one January of 2021. Okay, we put under contract about October of 2020. So at that point, up to now, currently, we have 2,000 units. So we have 8 different properties. They're located in 5 different states, 250,000 square feet, a little over that one. And our sweet spot is now this $5 to $15 million range. All right. And here is the locations of our properties. So you can see them down here. We have one in Texas. We have 2 in Louisiana. We have 3 in Mississippi, 1 in Alabama, and then 1 way up there in Connecticut. It's like, you know, we search. Just people ask us, where do we look? Truthfully, we search all over the United States. Excuse me. I used to tell people we look all over the United States, but we don't really tend to like ignore a little bit of the West Coast, and we tend to ignore the Northeast. And then we ended up buying a property in the Northeast. And so I really can't say that anymore about the Northeast. I can just say we look pretty much all over the United States, so we're open to find properties wherever we can find them. Now, when we're looking at properties, we're looking at many different properties, and this is just a little bit of like how we do our acquisitions and what's going on. It says here that we will analyze over 500 deals. I think that's actually 600, but you know, we've analyzed a lot of deals, right, since we started just kind of keeping track of these numbers back in March. 28 LOIs sent, so those are letter of intents. This is like an initial offering to purchase a property, and then since then got 3 of them under contract, and we're 3 under contract currently right now. Okay. And let's see. So when we're looking at properties, right, there's, for us, the Radiant Storage method is that we're looking for 4 different things, 4 different ways that we can add value, right? And what are those 4 different ways? So we're looking for properties that either have low occupancy, right? So, hey, there's just, you know, maybe it's 60% occupied. Well, why is it 60% occupied? Well, that's for us is good, because if we can get it up to a stabilized occupancy, then that's a lot of upside. How about low rents? We're looking at what are the rents currently? Are they somewhat near the market? Where are they compared to the market? And that's a great value add if you find a opportunity where there are low rents. How about expansion possibilities, right? Expansion. Is there extra land there? Is there land that's not utilized, or maybe it's utilized in a poor fashion? Say it's parking. Say there's just land for parking. Well, people just let them park all over the place and they just park wherever they want. Well, if you make it uniform, you can actually add probably another 5 spaces or something. What are some ways that you can expand on the property? All right, and then we're looking for operational inefficiencies, and this is one of the main things that probably every one of the properties that we've bought so far has some type of operational inefficiencies. And what do we mean by that? One of the things that we look at is payroll, like bloated payroll. Right? So a lot of self-storage facilities have a person in the office, and they may have a person in the office Monday through Friday, but then they are also open on Saturday, Sunday. So that means they have 2 different people on payroll, splitting the times. And for us, the way that we operate, and this we think is the way of the future, is that we're moving everything as unmanned for us. So we don't have a person in the office. We may even have an office in the front, but there's actually nobody in there who just sits at a computer and waits for people to kind of come in the door. And we don't have that. We make everything as automated as possible. So when a tenant wants to reserve a unit or wants to rent a unit, well, they can go to our website. They can go on their phone or their computer, and they can sign up 100% through the website. They can digitally sign, they can put in their credit card information, upload their driver's license. They can basically do it all online on their phone, on their computer. Or if they don't want to do it on the phone or computer, they can do it through our call center. And our call center is open 12 hours a day, 7 days a week, right? And a person in the office is not there 12 hours a day, 7 days a week. I mean, in general, they're not there that much. So we can eliminate payroll costs, right? I wouldn't say eliminate it 100%, because we still do have maintenance staff that helps us, but they're not customer facing. So they go there and cut locks, they pick up a little bit of trash, they make sure the gate is working. They just do audits, and so they're there, once or twice a week, but they're not there for the customer side, customer facing, right? So because we can cut down the payroll significantly, that's a huge benefit for what we can do. And that is done day one. So we can get into like, hey, we're projecting to do this in 3 years. We're projecting that we'll eventually be there in 5 years for this. We're projecting rents to go up. We're projecting this. Well, those are all projections, right? We hope that, that those were going to happen, and we're going to work towards that. But when it comes to payroll costs and be able to eliminate those payroll costs, that happens right away because that's our strategy going into it. So we don't, and that's, that's huge for us. So other operational inefficiencies, we see this all the time. We see limited websites. We see very just kind of informational websites, but not able to actually rent a unit on the website. And that makes a person have to like look at your website. So if you think of you're a customer, you look at a website, okay, I want to rent from them. Let me go click, oh, I can't rent. All I did is it gives me information. Now I have to call them, or I have to go down there and actually meet somebody during their office hours, which are not 7 a.m. to 7 p.m. And maybe that means I have to go there on a weekend because I can't meet their office hours. And it's just kind of like more hurdles, right? More friction to get through. We talked about limited hours. We talked about tenant insurance. I mentioned that not everybody has tenant insurance. There's a lot of storage facilities that we are buying that do not have tenant insurance, and that's a huge benefit for us, right? We see that on our facilities, we make all of our tenants have some type of tenant insurance. If they can use ours if they want, or they can use their own if they have their own tenant insurance, that's fine. But we see about 70 to 80% of our renters are going to use our tenant insurance. And again, we get a commission on that every single month. So those are some of the things that we're looking for. And we're looking for any kind of combination of those for the value add pieces.
Kyle, that's really amazing, especially the operational piece on day one. One
Sure.
quick follow-up question.
Mhm.
So you're implementing all this, day one, someone can walk in with a phone and rent. And it sounds like the tenant insurance is really limiting your downside or liability risk.
Mhm.
Other question would be, what does maintenance look like? I know I've done some due diligence on these facilities with you, but single family, like we're talking about paint, renovating the face of things. What does the operational maintenance look like on these places?
Yeah, that's, when you're talking about the difference in residential and storage, it's a big difference on the maintenance side, right? The maintenance side for us is just to make everything as functional and easy to use as possible, right? So you're talking about like, what are the moving parts in a self-storage facility, right? If you're talking about an outdoor drive-up facility, the moving part is a door, right? A door and a lock, right? So that's the only thing, right? You're not doing anything with the walls. You don't really need to change the walls. You're not painting anything. You're not putting any carpet or hardwood floors down. So there's no mechanicals in there. So we try to eliminate things like electrical, or there's no water going there, right? So it just makes it there's less things to break, right? So maybe a door, right? And the door railings, right? So the maintenance on them is very easy. It's really kind of like the hasps, which are where you put your lock, the things that go, the locking mechanism. We're just making sure that those work, the doors work, and that the roof isn't leaking, right? And that's really kind of it on the maintenance side, right? We don't have to worry about a lot of the other major mechanicals that you would in a residential property. If you talking about indoor facilities, sort of our higher class, class A, class B type of facilities where they have climate control, well, there you're going to have sort of indoor climate control. You have an HVAC system in there that you do have to maintain, but those rates are also higher and they justify that. But in terms of maintenance, it's really not much. And our maintenance team, is basically going there, like I said, once or twice a week, looking at the property, making sure that the gate works, making sure that the units that are supposed to be vacant are vacant, the units that are rented are rented, and just making sure that everything is just the way it should be, right? And it isn't like they have to do a whole lot when they get there, right? So they maybe take an hour or two, go through the property, and then that's it. They'll be back next week.
Yeah, most likely that's cleaning. Make sure that it's not dirty. If there's some trash, they will pick up the trash. If there's a tenant that is not, if they're late and then delinquent over 5 days, and they will go there and they do we call it overlock, putting our own lock, which Paul just explained it on the auction process. Yeah, things like that, but nothing major. Since we don't have toilet, nothing. There's no plumbing involved, nothing. So there's much less mechanical moving parts in this type of asset.
Yeah, I'll talk one thing that I thought was very funny. So on our very first property that we bought, all right, it was we'll go over it just really quickly in a second here, but that very first property we bought, I was interested to see what the water bill was going to be, because they had a person in the office, they had an office, and we weren't going to do that, but I wanted to see what their water bill was. because on my multifamily properties, the water bill is huge, and I'm the one paying it, and I'm like, wow, the water bill is just so big. I obviously want to cut that down and want to do things that, like, how can we reduce this water bill? So I was curious to see what the water bill would be like on our self-storage facility. So the very first bill came to us, and I was like, oh, let me check this out. And it's a 20,000 square foot property, right? The water bill came back $30. I was like, $30. I was like, I can't believe the water bill is $30. And I was like, well, that's too much, because we're going to cut it out. We're going to make it zero. We don't need water. So it went from like thousands of dollars at our multifamily property to $30, which I was like, ecstatic that like the water bill could be just $30. And then even still, that was too much for us. We just cut it off, and we don't need it anymore. So, all right. Well, let me get into some examples really quickly about pro forma. Now, this is kind of like an eye chart, and there's tons of numbers here, and they're like, what do all these numbers mean? And I'm not going to go over every single number. I'm just giving you an example of when you come to Radiant Storage and our type of deals that we do. Sean, you know this. We show people. We're trying to be like transparent about what we're doing, right? And when you're looking at a pro forma, oftentimes when you're looking at other people's deals, they don't show you this. They may show you like a projection, like, hey, you're gonna double your money in 5 years or 7 years or whatever it is, and you're gonna get a 15% IRR or whatever it is. They give you like these numbers, like, okay, that's what they're projecting, but they're not showing you actual underwriting, which is this, and so showing you like, okay, how are we getting there? And if you're able to dig into the numbers more, you're able to see like, okay, what ways are they saying they're going to improve the property that is going to get us to those numbers? And if they don't show you this, it's a little bit of like, well, I can just pull a number out of anywhere just to say, oh yeah, we're going to get our investors, I think we're going to get 18%, or I think we're going to get 17%. I don't know. But how does that work? Well, show me how that works. A lot of times other people are a little sensitive about showing this information, right? But Juan and I just feel like with Radiant Storage, we need to show people this. And so some of the things now on other people will show you these things. And I'm going to point out some of the areas that you want to look at just to be sensitive about, right? Just to make sure that you're asking these questions, or you're at least finding out what are the other operators doing in these areas. So the first one I'm going to say is like the very top, where you see where it says income growth, expense growth. And you see it at ours, it's basically 2% across the board. So that's 2%. This column is first year, second year, third year, fourth year, fifth year. So it goes to 5 years. And we're saying that we're projecting 2% income growth and 2% expense growth every single year throughout the whole time. Now, that's not going to be true. You're going to want to look at how other people do it, because if they just project, oh, well, our income growth is going to be 5% and our expense growth is going to be 2%, and that's going to be 5%, 2%, 5%, 2%. Well, and then it tapers down after year 4 and year 5 to like 3%. Well, that means they're just counting on just natural income growth. Now, I again could project that, and maybe that's true. Maybe that's going to happen, but I don't know. I mean, that can make your numbers just right there. That can make your projections just by saying, well, I mean, the rents are going to continue to go up, right? So that's not a way of necessarily being conservative. And that's what we want to say, is like, we want to be conservative and just say, hey, it's 2% expense growth as well as income growth. So we're not projecting something that is just kind of like pie in the sky. Now, another thing that I like to point out is this, let's see, this very, I guess, this column where underneath where it says current, okay, or it says income on the income box, and then it says current. And so that all those numbers all the way down. This is what the current property is doing right now, right? Before we take it over. Now, rarely does anybody show this in terms of the income and how the income is broken down, as well as the expenses and what are the expenses in the property currently. And they just start showing you, okay, well, this is what we're projecting in year 1, year 2, year 3. And without a reference point of knowing, okay, what is the current level versus what are we projecting in year 1? You have no real reference point of saying, well, is that number achievable or not? Like can you get there? I don't really know if that's I have no basis to know if that is like a valid point that you can actually feel that your income can grow that much, or it can or that your expenses are going to shrink that much. So these are the things that we show in here. It's like we show what the current is versus what our first year projections are. And you can see like what are the differences here and where we think that we can improve things in just year one, right? So those are, those are some of the things that, a couple things that I want to point out. And the last thing I want to just point out here is if you look, what we're trying to do just as an overall perspective on this deal. I mean, this is just kind of an example, right? Just numbers wise. But if you look at where it says economic vacancy, okay, here, economic vacancy, you see it starts out at 46.3% currently, and then we're dropping it down to 42% in the first year, 28% second year, 15% year after that, and then it stabilizes at 15%. So that means vacancy, economic vacancy is like in terms of meeting our gross potential income, like basically how many people are paying, and they're paying the rate that we're trying to achieve. We're saying that over time, we're going to stabilize in year 3 with 85% of the facility paying the current rate that we are projecting, and that they are we have an occupancy basically of 85%. So that's what we're saying that we're going to get to in year 3, right? So we're not saying we're going to get there in year 1, year 2. We're saying it's going to take 3 years to get to that point, which we feel is a conservative approach to it. And just so you know, that's like saying your occupancy is 85%, but truthfully, the sort of national average is more in the like mid 90s, so like 92, 93%, right? So there's some buffer in there that, hey, if we're at 90%, well, we're overachieving our pro forma, and that's some buffer that that means our numbers would be better, right? That we achieve better returns. But we don't like to put that in there. We just like to say, okay, what if we only get to 85%, and it takes us 3 years to get there? These are the numbers that we're showing here. And just so you know, this is an actual deal. This isn't like we just threw numbers in here just to throw numbers in here. This is an actual deal. Okay. All right. So why don't we get into a little bit more about, I guess a little bit of summary of like who we are and what we've done. So we'll talk to, this is our current self-storage portfolio. It is 8 properties. So these are the 8 properties that we have. You can see how many square feet they are, what city they're in, how many units they have, what is the date that we added them. So Central City was the first one that I talked about. It was the very first property we added in January 2021. Once we bought this property, Juan and I realized, hey, we have a lot of momentum here, even though we just bought one property. But we're actually gaining a lot of we're gaining a lot of momentum from brokers. We're getting we think we can do this, and we can do this again. So what happened is we bought another property. This was the 3 property portfolio right here. This is Mississippi. And we bought that one in July of 2021. We added this other one in Baton Rouge, another one in July of 2021, and another one in 2021. These are all July 2021. So we ended up with 6 properties in 2021. So we started with 1, ended up with 6. We added number 7, which was Galveston, which was in February of this year, 2022. And then our latest one that we've added was in Connecticut, which was in May of 2022. And those are our last ones. So that's where our portfolio is right now. And here's some of the just quick highlights of some of our older properties that we bought in the beginning, because they have the longest history with us. So we can kind of give you like, what are the numbers? So now that we've held them for a year and a half to a little over a year, what are they doing? Right. And so we took about, this is our property. It's called Radiant Storage GPT-3. It's our Mississippi properties. It's a 3 property portfolio. So you can see it's down here in the Gulfport of Mississippi. Size is 62,000 square feet. It's 450 units. The purchase was $1.54 million, 1.54. And when we took it over, you can see the NOI when month 1 through 3 was $43,900, so about $44,000, and it was 97% occupied. So it was highly occupied. Where did we see the value add in this? We saw the value add, but the rents were very, very low. Okay, the rents were very low. They did not have tenant insurance. You couldn't rent online. They had payroll, so they had a person at each of the locations. So there's 3 locations. So there's three people on payroll. Right. So what did we do? We took the NOI. Now that NOI in the last, I guess sort of the latest 3 months that we calculated was 59, almost $60,000, okay, with a T3 NOI. So it went from 44,000 to 60,000. So a huge gain in NOI in this property. Current occupancy, it's actually a little bit higher now. When this slide was created, it was 83. It's actually at 90% right now between the three. Now, we looked at the valuation. You use the valuation of basically this T3 NOI, and you value it at a 6 cap, which is the numbers that we're talking to our bankers about doing a refi right now. We're in the very, very early stages of doing a refi, and we're thinking that this property, this is where the value is going to come out to be. And this was done in 12 months. So we have achieved all this in 12 months. We actually achieved it in 10 months. We've just been sitting on this property for a little bit, just let it season a little bit longer before we actually start that refi. And probably the refi will start this year, 2022.
And
Okay.
Pal, just for people that might not be super familiar with real estate, NOI, net operating income, is it fair for me to think about that as kind of like, when I look at gross income, net income, this is basically just kind of profit after expenses?
Yeah, and the easy way to think about it is you take all your income, and then you take all your expenses except for your debt. Okay, so besides your debt, and then you take the difference of those two, right? So your income, your expenses, don't include your debt, and then that's your NOI. Okay, net operating income. All right, and that's how you base the value of a property in commercial real estate. You get your NOI, and then you divide it by a certain cap rate. And in this case, we're dividing it by a 6.0 cap rate. So if you change that cap rate around, it makes the value different. So you can see that this property went from a 1.54 million to basically almost a $4 million property at this point. And that's we did under a year, but we haven't executed yet on the refi. So once we execute that refi, that's a huge gain. We're talking over 100, almost 160%. All right. Let's take a look at another one that we had, which is in Baton Rouge. Okay, this is one of our Baton Rouge properties. So you can see the size of this. It was 20,000 square feet. It was 155 units. We purchased it at $620,000. Again, July 2021. NOI at that time was about 8,800. It was 60% occupied. So we saw it 60% occupied. Hey, that's good for us. A lot of upside. Well, in the last 3 months, we've got it to the NOI is 11,451. Right, so sizable increase there, and also the occupancy is at 86%.
Mm-hmm.
So if you remember, go ahead.
Yeah, just to add to that, 60% was physical occupancy, but we just talked about economic occupancy, right? Could be tenant not paying and things like that. So I think this one, the economic occupancy was more like about 55.
Yeah, so about 55%.
Mm-hmm.
So now remember we projected in this deal as well that it would take us 3 years to get there, 3 years to get to that point where we would be able to even think about 3 years to get to the point of stabilization, which is occupancy over 85%. So we got there with this one in under a year as well. And we are also in the early process of starting to think about refining this property as well. So, and here's the very first one that we bought. This one was bought, you can see again, it's 20,000 square feet. It's in Central City, which is a part of Baton Rouge as well. 20,000 square feet, 175 units. $675,000, our very first purchase, right? We're talking January 2021. And NOI at that time, 10,200. Occupancy at the purchase, 65%. Again, physical occupancy. Your economic occupancy was more like 60%. NOI is 14,300 is what we're seeing in our last 3 months, right? Current occupancy is actually 80%. It's actually 85% if you look at how many units when we took over, but we added some more units there. So the total number of units is larger than it was before. But if you take just the units that were there before, we're actually at 85%. So again, you take the valuation of this, you take your NOI, your annual NOI. So you annualize this number, divided by 6, you're coming up with a $955,000 valuation at this point. So we're looking to refi on this property as well. So again, we projected that again it would be 3 years before 3 to 4 years before we could get to this point. But we're doing this in our properties at 12 to 18 months. Okay. Excuse me 1 second here. Dry throat. Okay. So that is, I would say that is it, Sean. That's those are all the, just kind of going through a little bit about who we are and what we've done. But that's the end of the presentation here.
Yeah, I appreciate your time. So kind of to recap, you look at a lot of deals, find the ones with some sort of vacancy, and that's because of an operational deficiency where you're basically just making it easier for people to rent. Come in, do that day one, and then over about a year and a half, you're basically just getting more paying tenants in there, raising the occupancy, and then that then raises the value of the property. And that's kind of the overview of the method as far as I understand it. Is that a good synopsis?
Yeah, and that's what we've done sort of in that year to year and a half. Again, we're not projecting that on our numbers, so we don't want to say that to hold us to this year and a half time frame, because that's their property. That isn't the case for every property. Again, we're trying to do that in a more like a 3 to 4 year period. But if we can do it sooner, hey, that's even better for all of our investors.
No, I appreciate that, and I know that you talked about that when you're looking at the pro forma, that all your projections are very conservative, which seems like that's kind of the opposite of what people do. They they have very high aspirations for what's going to happen. I might be unrealistic, whereas you're at making very low bars to meet, and you're kind of blowing that out of the water in multiple instances.
Yeah, appreciate that. Yeah, and that's what our goal is, right? We want to be able to like show some good returns, but we want to have a lot of upside that we're even not showing as well.
All right, well, Pal and Juan, I appreciate your time and kind of walking through the whole method and how this all works, and really boiling it down for someone who might not have ever done a deal in multifamily or let alone self-storage. So look forward to working with you again in the future in more deals. And yeah, again, thanks for this explanation, this presentation.
Appreciate it, Sean.
Right.
Thank you. Thank you so much.
All right.
Thank you, Sean.